Today on InvestTalk, we talked about some of the things you need to consider if you want to live abroad, answered questions on saving for your kids, ticker SLP, and some of the things we're discussing with our clients, and then ended the day talking about the diminishing power of Saudi Arabia on the oil market.
This is InvestTalk, independent thinking, shared success.
Now, my main focus point today is really an interesting topic. And that's because an increasing number of Americans are retiring abroad. In fact, the number of Americans choosing to retire abroad is on the rise, such that from 2016 to 2024, the number of Social Security beneficiaries living overseas grew from 500,000 to 760,000. While not all of these retirees, surveys reveal, while not all of these are retirees, surveys reveal an increasing interest in moving abroad driven by factors such as lower living costs, improving quality of life, and overall just a desire for a different type of adventure in retirement. So what are some of the advantages of first retiring in the US? Well, for one, proximity to family. Staying stateside means being close to friends and family, especially grandchildren, and maintaining established social networks that support physical and mental activity. There's also continuity of care. U.S. retirees enjoy access to familiar healthcare providers and services, avoiding cultural or language barriers that come with relocating abroad. Many retirees continue to even work part-time or stay professionally connected, so staying in the U.S. can simplify networking, and pursuing career-related opportunities will become easier. But there are also some challenges, right? Healthcare, housing, daily expenses are significantly higher in the US compared to many other countries. In fact, a 65-year-old couple needs approximately $330,000 saved to cover healthcare costs in retirement. Compared to countries with stronger social safety nets and lower income inequality, the US ranks lower in global quality of life surveys. Retirement in the US may also feel predictable for those who are seeking fresh experiences and cultural exploration. That's been driving a lot of people overseas. So what are some of the advantages of deciding to retire abroad? Well, living overseas offers some pretty unique cultural experiences, cuisine, climates, which can contribute to healthy aging and also personal growth. Many countries offer lower cost of living with affordable healthcare and housing options. Social security benefits often also remain accessible to people who decide to move abroad. Public healthcare in some countries is low cost or free, and private insurance can be significantly cheaper than comparable US options. What are some of the popular destinations? Well, countries like Mexico, Canada, the UK, Germany, and Australia rank highly among American retirees, offering favorable visa policies, affordable living, and familiar cultural aspects. So if you want to consider living abroad, there are some things that you should be doing. One is start planning early to manage visas and financial requirements. Another, visit your desired location multiple times to ensure it aligns with your retirement goals. Research healthcare and insurance options specific to your destination. But more importantly, this is just another goal that you may have that fits into your full financial profile. Retiring abroad can sometimes offer the promise of adventure and savings, but it requires careful planning to navigate the logistical and cultural adjustments that come with living in a new country. And just remember, you don't have to do that alone. There are plenty of financial advisors. There are plenty of financial people within the financial industry that can help you create that comprehensive plan, no matter what your goals are, whether you want to live in the US or overseas.
We appreciate you watching. Don't forget to like this video and subscribe to our channel for more content.
Let's talk a little bit about the market. US stocks were lower overall in what really was some uneventful trading on today. The Dow down 55 basis points, S&P 500 down 19 basis points, NASDAQ down 18 basis points, Russell 2000 leading the way downward, down 1.25%. This coming on the back of a higher finish on Wednesday that saw the S&P and NASDAQ set fresh record highs. The S&P, because it finished lower today, that means it's finished lower for only the second time in the past 13 sessions. Today's underperformers included semis, crypto-linked names, software, managed care, medtech. Outperformers included airlines, energy, banks, insurers, pharma, hotels, and tobacco. Dollar index was down 60 basis points. Gold ended down 1%, and crude oil settled down 40 basis points as the market processed some of today's headlines coming out of OPEC+. Like I said, very quiet session overall. Market was largely in waiting mode for the non-farm payroll data that's supposed to come on Friday, which is tomorrow. Also, some headline noise about Bitcoin finally taking out the 100,000 level, but that didn't really translate to any equity strength within markets today. Recent focus has still been on tech outperformance, coming off of a harsh November. Pick up in December, Fed easing expectations, and really this favorable seasonality that I mentioned at the top of the show, as well as some strong trends in terms of capital inflows. Jobless claims today was really the only major economic release that I saw. The weekly initial claims printed higher than consensus, while continuing claims posted an unexpected drop week over week. More important data, as I said, hits on Friday with the November non-farm payrolls, which are expected to see a little bit of a bounce, right? Because we had the storm and strike headwinds that had depressed the reading from October. No real Fed speak of consequence. While commentary kind of earlier in the week really leaned towards a dovish tone, more recent takeaways have focused on the idea that we need to be patient, right? That rate cuts may not come as quickly as some had expected. But even with that in mind, the market is still currently pricing in more than 75% probability of another 25 basis point rate cut at the December meeting. So certainly all eyes will be on that in the coming weeks.
Hi, I'd like to get your input on AeroVironment Incorporated, stock symbol AVAV. Thank you.
So AeroVironment Incorporated, ticker AVAV, is a aerospace defense company. They design, develop, and produce robotic systems. So think about UAVs, unmanned aerial vehicles. Think about kamikaze attack drones, unmanned ground vehicles, essentially next generation aerospace and defense technology. Now, it's a $5.5 billion market cap company with very little debt, only $47 million. And that's because they generally have been capitalizing over the past 5 years by issuing shares. 2020, they had 24 million shares outstanding. Now that number stands at about 28 million as of the most recent filing period. Now, in terms of profitability, they had a rough patch back in 2022, 2023, where their net margin went from negative to very negative. As negative as negative 32.6%. Now that's turned a corner. Last year, 8.3% net margin. This year it's projected to be about 10.4%. So those margins are expanding. What about the revenue? Well, the revenue's grown at about a 17.9% annualized growth rate over the past 5 years. But they're still down. Oh, I'm sorry. They're not down. They made about $716 million last year in revenue, projected to be about $821 million this upcoming year. Their fiscal year ends in April. And so when you look at this, the company's cash flow is set to be positive. Their free cash flow was negative $7.7 million, projected to be $34.1 million this year. That is certainly something we like. Their margins are expanding in the correct direction. They've had consistent earnings upgrades. Now, it's not for dividend investors. They do not pay a dividend, and they have not paid a dividend. And so we talked a little bit yesterday about how aerospace defense companies may be doing well in the future because we may be reorienting our military in a new administration. There certainly could be rearming in Europe, something that we will talk about, hopefully, if we have time at the end of the show. But more importantly, is this company that fits a good theme and that is fundamentally moving in the right direction, is it a good value? And even though it's fallen off a little bit, 15% today on the back of some unfortunate earnings after the close yesterday, it's still trading at 50.4 times forward-looking price to earnings, still trading at 91.8 times price to cash flow. Incredibly high. Now, it could be because this is the intermingling of aerospace defense and quantum computing, artificial intelligence, and so it's been bolstered because of that. And even with it down 15% today, it's still up 31% year to date. And so this is a name that I would keep on my watch list. They just gave poor guidance. They just had poor earnings. But it still seems to me to be a little bit, if not a lot bit, too expensive at the moment. So I'd keep it on my watch list. Thanks for the call. Now, you probably noticed that we don't only answer questions from the InvestTalk voicemail, we also answer questions that come into our YouTube comment section. And that's because if you are watching our videos, well, we appreciate you and we appreciate all of our listeners as well. But if you're watching our videos and you don't want to dial the phone, you can leave your question right there in the InvestTalk comment section. And this one came in and it's about Uber. And it said, interested in your thoughts on Uber. Isn't it a bearish consolidation? Would you sell or wait for new highs? Well, Uber's down a bit today, down about 10%. And that's even on the back of some news related to a joint integration with Toast, right? Expanding their partnership to help restaurants reducing costs. And the thing that really was bad news for them today was that Waymo is going to expand its services to Miami. And so that saw Lyft and Uber fall off a little bit. You know, I talked about Waymo probably a couple months ago in that I had firsthand experience of maybe some of the pitfalls of driverless cars in that, well, they blocked an entire road of San Francisco when I was there, and it took them about an hour for things to start moving again. And so maybe I'm less on the train of the success of driverless cars as some people, but it'll still be a development that certainly will hit at Uber and Lyft's customer base. Now, looking at Uber specifically, Uber is a $151 billion market cap company. They don't have much debt, about $13 billion. And that's because they love to issue shares, up from $1.7 billion to $2.1 billion in the past 5 years. Now, if you've been following this stock, you know that they just recently turned positive in 2024 in terms of earnings per share, right? It's the first time that they actually made money. And because of that, they do not pay a dividend like many of these companies do not. Now, the revenue has been growing pretty significantly from $11.2 billion in 2018, projected to be $43 billion this year. But most of that growth was really in the back half, coming out of the pandemic, from about $11 billion in 2020 to $31 billion in 2022. Still pretty solid growth over the past 2 years, but there are a lot of threats on the horizon against Uber and Lyft's businesses. Now, their margins are expanding, but you know what? When you were this negative for this long, they tend to expand. Right? Oh, I'm sorry. They actually made money in 2018 was the first time, but then they lost some money during the pandemic. And so margins are definitely on the correct track, as is cash flow. You see cash flow jump up, operating cash flow jump up to $6 billion this year, up from $2 billion last year, and then obviously negative territory the year before. That makes free cash flow at $6.85 billion is where it's projected to be this year. So all of this certainly is positive for Uber, but let's take a look at the relative valuation. Price to book about 10 times, very expensive. Price to cash about 25 times. Not where it has been, but you know what? A lot of this is muddied by where the company was during the pandemic. And so you see this ridiculously high number of 48,000 forward-looking price to earnings. That's not reasonable, right? This has to do with what's going on fundamentally in terms of the numbers coming out of this time where they were negative. Now, with that being said, I do think that what you are likely to see is more of this corrective territory, especially given the backing that Waymo has and the capital that they have to expand their business. I think that, you know, Uber benefited from capturing a market with a very reduced cost and then raising prices, right? That's why they started making money. Now in Los Angeles, we have Waymo. I actually see that Waymo is a lot cheaper than Uber and Lyft. And so I think there are a lot of threats here. I think there's likely to be a continued consolidation of this price to the downside. It could break below 70. So I certainly would not consider buying any more until we see a little bit more consolidation, a little bit more strength where the price is currently floated. I think there's just a lot of things that need to be repriced here. I don't like that they continue to issue shares. And anytime you have a little bit of a downgrade in forward-looking guidance, that's certainly a time to maybe rethink if now is the right time to enter. Thanks for the call. Let's go ahead and play another InvestTalk listener question now.
Just had a quick question about investing for my young son. I've been doing about $250 a month, but I put it just in a mutual fund. My thought is I don't want to really do a 529 because really I want to help this payment go towards like a down payment on a house or something like that whenever he's like 30 or something, if I'm still alive, but just give him the big lump sum of money rather than just it go into education. I've heard some new things about 529, about some other benefits with doing it, but just want to check in with y'all. Thanks.
Great. So 529 plans are great ways to fund education, right? They cannot be used for a down payment on a house without penalties. They're primarily limited to education-related costs, be it tuition or books, fees, room and board, anything that goes towards that all-encompassing education for your child. And it's also important to note that if you decide that you want to pull from those funds, well, just like retirement accounts, there are penalties associated with them. There's a 10% penalty on earnings plus income taxes that will apply, right? 529 plans are taxed advantage accounts. So if you don't use them for education, well, there are penalties. Now, similar to like a Roth IRA, you can also withdraw contributions, not earnings, but contributions tax-free because the dollars you're putting in are after tax. But again, that reduces the growth benefits. And then the question for you is, and first and foremost, I want to say excellent job as a parent. Those who can afford to help their children save early because the power of compounding is the greatest thing on your side. Very well done. And if you want to use it for a house, I think it's perfectly fine to put it in broadly diversified, low cost. Remember, costs are the things that tend to eat away the most at returns over time because they compound as well. Low cost mutual funds for a longer time horizon to help save for your child's future. So overall, I think if your goal is to save for a down payment on a house, this is an excellent way to go about it. Plus, it gives you the optionality of maybe he doesn't want to buy a house or she doesn't want to buy a house. Maybe they want to use it for something else. Either way, the capital you're saving now will pay dividends, pun intended, for your child in the future. Let's go to John from St. Louis, who has a question about SLP. Do you own it or are you looking to buy it?
I own it.
Okay. So what kind of advice are you looking for?
I'm basically just wondering what you guys think about the stock, and particularly at these levels that they're at right now. I bought it at right around 31.74, right at 31.74, and I like the idea of the company. I am just curious if you think that it has a shot at improving in the somewhat near term, or if it might be a longer way. I know it's in the healthcare industry, but they don't really mess with drugs per se. They deal more with like a drug software, if I understand, along those lines. And I thought it might not be as affected by like the scare of the new administration coming in affecting healthcare stocks. But I was just calling to see what you thought about it.
Yeah, of course. Well, ticker SLP is Simulations Plus Inc. You are correct. They're kind of a software and consulting company that rather than creating drugs, right, within the healthcare space, they are kind of like the backbone to create services and software to support drug discovery. Now, with that being said, right, you mentioned that the next administration is, if RFK Jr. is the incoming HHS secretary, if he gets confirmed, he has said that one of the things he wants to do is halt drug development. And what that would mean, right, is that companies that are consulting and creating software that may help support drug discovery, well, they wouldn't do particularly well if the regulatory backdrop makes it more difficult to develop these drugs. Now, it's down about 33% year to date, down 13% over the past 3 months. But I think the thing that is more alarming for this company to me, right? It's a very small company, 624 million. It's got very little debt, only about $1 million in debt. They have issued shares. They issued about 10% of their shares in the past 5 years, up from 18 million to about 20 million. But their revenue is certainly growing at about a 15.6% clip over the past 5 years. But their margins are shrinking, right? That's a business that is not running as efficiently as it has. And it's shrinking consistently from about 30% net margin back in 2018 all the way down to 14% this year, each year being worse than the last. And while it's doing that, it's still trading at a pretty expensive price. Forward-looking cash or price to cash about 46 times for a company that's having shrinking margins. And so if I'm being honest, I think that's a pretty big worrying sign if you're not able to capture new revenue at scale in such a way that your margins at least stay consistent, if not expand, and your free cash flow is falling as well. There's about 6% short interest out there, so a pretty decent chunk of the market thinks that it has some room down to run. It's kind of tough. I think that it's one of those situations where, again, some of the things look good revenue growth, but there could be some regulatory headwinds and margins are in the wrong direction. So, honestly, I think there's probably areas of the market where you have better uses for your capital that maybe don't have some of the headwinds that a company like Simulations Plus has. Does that all make sense?
Yeah, right on. Thanks, Luke. I appreciate it.
Yeah, thanks for the call. That was Simulations Plus, ticker SLP. Looks like we have another live call. I was taken aback for a second because this gentleman is also named John, and you have a question about LLY. Do you own it or are you looking to buy it?
I'm looking to buy it, but I don't know what's a good time to buy. Yesterday was popped up 2 times, so I was thinking it's a good time to get in or wait to pull back more. Thank you.
Yeah, of course. So LLY, Eli Lilly and Company, it is another company in the healthcare space, except this company does create and manufacture new drugs. And so because this is more benefited from, the GLP-1 trend has really driven a lot of revenue growth over the past couple of years. You go from 25 billion or 28 billion in 2022 in revenue to 45 billion. You see those margins expanding from 29% to a net margin of 32%. So this is a situation where you have a company that has expanded growth, right, in terms of revenue growth, and they also have expanded margins. And so let's take a look at their cash flow on a charted thing on my screen. So it's going to take a second to pull up. But either way, this is a very, very large company, about $788 billion market cap, $31 billion in debt. So plenty of room to run there with an interest coverage ratio of 23 times. And their cash flow is improving. Their free cash flow is set to grow from $793 million to $7.8 billion this year. That is something that we certainly like to see. Now, with all that in mind, it's trading a little lower than it has been, and that's because it's down 9% over the past 3 months, even though it's still up 41% year to date. And so its forward-looking price to earnings, about 38 times, is kind of expensive over its 5-year range, but a lot of that has been bolstered over the past year. But still, I think you have an issue when you have some regulatory headwinds for this as well. A lot of people are skeptical for good or for not good reasons about GLP-1s. And there could be some increased scrutiny there. And unlike some other pharmaceutical companies that I've been looking at, this isn't priced in such a cheap way where you could say, okay, well, if the worst case scenario for pharmaceuticals happens, it's already priced into this name. This name is still pretty expensive. And so I would kind of wait and see what happens. The reality is of an incoming administration is there isn't always going to be agreement on who gets what position. There are going to be differing departments that have overlapping oversight over various aspects of the economy that may have butting heads, and you don't really know how it's going to shake out. So we're at a time where, we're about 2 months away from getting the ball rolling on moving into a new policy dynamic, new regulatory framework. And so with that in mind, I think especially for Eli Lilly, which again is still kind of expensive, it could have some more room to the downside. I think it has some kind of asymmetric risks compared to some of these other pharmaceutical companies, which have already really taken in a lot of the brunt of this worst case scenario for their business. And so for Eli Lilly, I'd keep it on my watch list. I would not buy into it yet. Thanks for the call. Now, we just talked about pharmaceuticals, but let's talk about another area of the market which could have some changes, and that is banks. Bank stocks have been climbing since Election Day, but the underlying risks for the sector are far from resolved. The S&P Regional Banks Index has risen 12% since November 5th, driven by expectations of deregulation and relaxed capital requirements under President-elect Donald Trump. Now, these changes could boost earnings over time, but they come with significant uncertainties. Trump's proposed tariff hikes are a major concern. While they aim to protect American industry, the resulting inflation could drive up interest rates and in turn drive up bond yields. And for banks, which heavily invest in these long-term fixed rate assets like treasuries or government-backed mortgage bonds, rising yields could translate into substantial unrealized losses, which would in turn weaken their balance sheet, right? We saw the effects of that in March of last year, right? This echoes the circumstances that led to Silicon Valley Bank's collapse in 2023. And so adding to the uncertainty is really the question of how the new administration would handle future bank failures. While the largest banks like JP Morgan are widely considered widely in the category of too big to fail, the fate of smaller regional banks still kind of remains unclear. During the 2023 crisis, uninsured depositors at Silicon Valley and Signature Bank were rescued under systematic risk exceptions, right? There are levels of deposit bases which are insured, and the Biden administration waived those. They wanted to prevent continued runs on banks, especially regional ones. But Trump has previously expressed skepticism about bailouts, leaving investors unsure about his administration's stance. And so the problem is kind of widespread, right? Because as of June, unrealized losses on U.S. banks held to maturity bonds stood at $310 billion, down from a peak of $390 billion last year. Now, for those of you who haven't dove into financial accounting, if something's held for maturity, well, you don't have to recognize the loss on your balance sheet. When you move it over into the available for sale or trading accounts, well, that's when you start recognizing it. So all these losses are banking up on the balance sheets of banks. For smaller banks, these losses represent a significant vulnerability. Recent events, such as the October failure, First National Bank of Lindsay, where uninsured depositors lost 50% of their money, have highlighted the risks for customers outside the largest institutions. We're not talking about investors. We're talking about customers, those deposits. The broader banking industry, therefore, faces a delicate balance. While deregulation, specifically on the capital requirement front, could boost profitability, increase risk-taking in the short term, rising interest rates and potential failures could test these sectors' resilience. And so for now, the outlook for regional banks is kind of uncertain. Right? I am more in favor of those larger institutions that have stronger balance sheets, more diversified loan books. And so both investors, but also more importantly, depositors would be wise to tread carefully. Now we got time, so let me drop another question from our InvestTalk YouTube channel. This one on ticker NVT. It says, would love your thoughts on the stock NVT. And NVT is nVent. nVent Electric, that is. And what they do is they're an electrical company. They provide services and products and solutions to connect and really integrate building systems, right? So they work with industrial names. And what they're trying to do is essentially increase efficiency within the building electrical systems, improve performance, and kind of lower costs overall. Now, this name is a fairly large name, right? Mid-cap name, about 13 billion market cap. And their revenue growth over the past 5 years has been pretty solid, about 8%. And for a company in this space, that's pretty solid, 8% on an annualized basis. But it is set to lose in terms of revenue, right down from 3.2 billion to 3.1 billion this year for the first time in 5 years. So falling revenue. Now, even though their revenue is falling, let's look at their margins. Their margins are relatively consistent. They peaked out last year about 17.4%, but it looks like there's a little bit of mean reversion going on and still above the other 5 years out of the past 6. Now, they have 2.3 billion in debt on their balance sheet, which is not something to be too concerned about. Not a lot of short interest, and they have been buying back shares consistently over the past 5 years. Now, they spun off from Pentair in 2018, and since then, there's been a lot of solid revenue growth. Like I mentioned, their net income is set to fall from 567 million to about 443 million this year, but their cash flow skyrocketed coming out of 2022. And so with all this in mind, right, a company that's got a solid balance sheet, its growth is slipping a little bit, but still looks fine. Its margins are kind of mean reverting and still higher than what we've seen. Its profitability still looks solid. And it's up 31% year to date, up 43% over the past 52 weeks. So how does it look in terms of cost? Well, it's a little expensive. It's at the upper end of its forward-looking price to earnings, sitting at about 25.5. 26 is the high over the past 5 years, 4 times price to book, 20 times cash flow. And honestly, for an electrical systems company, that is just pretty darned expensive. It's had an incredible run over the past year. It's had solid growth. Its profitability looks great. But you know what? I think we need to sit back and relax and see this company take a little bit of a pullback because it is too expensive right now. Thanks for the comment.
I've been listening to your podcast for a little while now, and I'm a new advisor out of North Carolina. And I was just calling to see what are some of the market topics you're having conversations with clients and potential clients as to why it's important right now to partner with a professional or switch over from doing their own investing to working with somebody regarding the situations happening today in the world. Thank you so much, and you guys have been so great. Have a great day. Bye.
Well, thanks for listening, and congratulations on joining us advisors. And you know, I think here's the thing, right? The topics that we're talking about with our clients are the exact same things we say and discuss for our listeners. And the whole thing here is that there is a lot that is going on. There is a lot that is changing from a macro perspective, political perspective, a lot of things going on. And so the biggest benefit to you in having a financial advisor, and this is what you can tell your prospects and your clients, and because it's true, this is true, I fully believe this. Life is far too short and too complex for people who are also working in other jobs outside of the finance industry, who want to spend time with their families, to keep track of everything they need to keep track of, to create the best, most efficient financial picture in order to achieve their financial goals. And so that's the job of a financial advisor, not just to help them with their investment strategies, but honestly to hold their hand, because we have experienced over the past 2 years a historic run-up in equity markets, right? But it's not always going to be glossy. And so the primary job is to keep your clients focused on why you're doing what you're doing and to help them achieve their financial goals and give them the peace of mind that they can do the other things in life that they enjoy while you're devoted to their financial future. Join our community of savvy investors. Subscribe to the KPP Premium newsletter for expert analysis and stock ideas.
Hi, this is Isaiah from Dayton, Texas. I'm calling about the stock ticker EXPE, Expedia. Just looking for your thoughts on this stock and an entry point. Thank you.
So Expedia, ticker EXPE, Expedia Group Inc., is an online travel e-commerce company, right? It has a bunch of brands in there, but primarily they operate B2C and B2B, and most of their business is B2C, right? 71% of their revenue. Now, as you would expect, 2020 and 2021 were not great for this company. And because of that, they only have about 2.7 annualized growth rate over the past 5 years, but they had to dig themselves out. So in reality, they've grown from 5.1 billion in 2020, projected to have a revenue of 13.5 billion this year. And in that time, their margins have started to expand again from about 10 basis points in 2021 all the way to 11.6% net margin this year. Now they have some debt for a $24 billion company. They got about 6.5 billion in debt, but honestly, that's not that much. And since 2022, coming out of the pandemic, they've been buying back shares down from 160 million-ish shares outstanding to about 130 million this year. And cash flow has improved in that time as well. Now, it is also trading at a relatively inexpensive price, only about 13 times forward-looking earnings, only about 9 times the cash flow, well within the range of the past 5 years, even considering how poorly the company was doing coming out of the pandemic. And so what I'm seeing is profitability tracking in the right direction, growth tracking in the right direction. And even though the company's up 41% in the past 3 months, up 38% in the past 52 weeks, I still think it does have some room to run. And that's because, there's been a lot of talk about costs affecting consumers and the economy hitting people's pocketbooks. But the reality is we've had more vacation booking, more flights in the last quarter of Q4 than I believe that. Right? People are still buying vacations, flights, hotels, all of these things. And so as the economy continues to recover and expand into next year, as costs, inflation, should it come down sustainably, though there are some warning signs, potential red flags of inflation resurgence. But regardless, you could have a consumer that is looking to spend again into next year. And so companies such as, Expedia or Booking or any of these businesses stand to do well, especially a company like Expedia, which still is trading at a relatively cheap price. And so for Expedia, therefore, not a lot of debt, great cash flow, improving margins. I like it. Thanks for the call. Now, before we head off, I want to touch a little bit about how Saudi Arabia's dominance over the global oil market through the OPEC is facing significant challenges. The kingdom, long the leader of the oil cartel, is now grappling with internal dissent and external pressures as it tries to keep prices high while managing growing competition from North America. And the stakes for Saudi Arabia are high, right? Elevated oil prices are really critical to funding their ambitious $1 trillion infrastructure projects aimed at reducing reliance on oil. Yet, within OPEC Plus, several members, including the UAE, Iraq, Kazakhstan, are pushing to increase production and maximize short-term profits, threatening the kingdom's strategy. Adding to the pressure is President-elect Donald Trump's pledge to unleash U.S. oil production, further undermining OPEC's influence on the market as a whole. Now, Trump's energy policies, which include looser regulations and expedited leasing of federal lands, are expected to drive U.S. oil output to 13.5 million barrels a day by 2025. It's nearly 50% more than Saudi Arabia's current production. This surge in supply could weigh heavily on global oil prices, with Wall Street already positioning for weaker prices ahead. And so within OPEC Plus, there's some frustration brewing, right? Some members argue that Saudi-led cuts have primarily benefited competitors like U.S. shale producers, while others fear losing market share. The International Energy Agency, the IEA, estimates that global oil supplies could outstrip demand by over 1 million barrels per day next year if OPEC Plus doesn't cut output further. And so whether the strategy pays off remains to be seen, but one thing is clear: OPEC's influence in shaping the global oil market is being tested like never before. I'm Luke Guerrero. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify, and please be sure to leave us a rate and review. Remember, we can help you better understand your portfolio dynamics and calculate your investor risk number. Just go to investtalk.com and click the portfolio review button. This is a free and confidential service, and if you haven't optimized the potential of your 401k, well, guess what? We can help you with that too. Independent thinking, shared success. This is InvestTalk. Good night.